pension system, and retirement planning. Pension deduction is the biggest deduction from our incomes. The core of financial planning is retirement planning. Numbers and the ratios change every year or every quarter. Figures presented here are for reference only. Plan of the talk. Describe the role of old age security. Describe the role of the Canada Pension Plan. These two parts are government-based pension systems. Explain the difference between defined benefit and defined contribution retirement plans. This is employment-based pension system. Describe types individual retirement saving plans. The above forms 4 layers of retirement incomes in Canada. Plan 2 of 2. Describe type retirement income conversion options. It essentially says how much you can get every month. Present key decisions you must make regarding retirement plans. Illustrate how to estimate the savings you will have in your retirement account at the time you retire. Brief introduction to retirement systems. Old age security and Canada Pension Plan are government programs. The amount of CPP benefit is based on the amount of contribution. The amount of OAS benefit is based on years of residence in Canada. It is also based on the other source of retirement incomes. The more income you have, the less OAS you will receive. Company pension plans are employment-based. Registered Retirement Saving Plan (RRSP) and other type plans are tax-deferred or tax-deductible individual retirement accounts. Old Age Security Program. It is a federal program from general tax revenues. Criteria are age and residence requirement. You have to live in Canada at least 40 years since turning age 18 to qualify for OAS pension. You will get a partial pension if you live in Canada for more than 10 years since age 18. The age of eligibility is now 65. Will gradually rise to 67. OAS benefits may be deferred to up to age 70 with increase of 0.6% per month that you defer your payment. Old Age Security Program 2 of 2. The maximum monthly OAS pension for the period of April to June 2017 was $578.53. The amount is adjusted quarterly. OAS clawback. OAS benefits are subject to a means test. If your income exceeds a certain amount, the benefit you will receive from the OAS program will be reduced. In 2017, the OAS pension was reduced by $0.15 for every dollar of net income above $74,788. At $119,615, full repayment is required. Calculating the maximum pension benefit. From the formula for pension benefit, we can calculate the maximum monthly pension benefit. For the year 2017, it should be, from the calculation we get, $560.33. This is roughly equal to, but smaller than, $578.53, the maximum pension benefit at second quarter. The maximum OAS pension payment is adjusted every quarter. Guaranteed income supplement. It is payable to a pensioner who is at least 65 years old and whose sole source of income is the OAS pension. At 2017, the maximum is $864 monthly to a single, divorced, or widowed pensioner, or $520 if married and both spouses getting OAS. If a pensioner receives any income other than the OAS pension, the GIS benefit is reduced by $0.50 for every dollar of additional income. Here is an example of OAS GIS calculation. So old age security and guaranteed income supplement calculations. Martha is a 66 years old OAS pensioner married to Fred, who is a 65-year-old OAS pensioner. Both of them were born and raised in Canada. They have no other sources of income besides their respective OAS pensions. Martha's total income for the month would be $578 plus $520, which is $1,098. Similarly, Fred's total income for the month would be the same. As a result, their combined annual income from OAS and GIS would be $26,000, calculated as the monthly income times 12 times 2. So we can calculate the minimum income after retirement in Canada. So suppose you don't have any other income. So the amount of money you will get from government is this amount. OAS is 578, and for GIS, single is 864, and for couple is 520. So you can get total single monthly income you add OIS to GIS single, you get roughly $1,400. And for couple, you add maximum OIS plus maximum GIS couple is 578 plus 520 and times 2. So you get a little bit higher than $2,000 per month. And you can also calculate this annual income by times 12. So that is the minimum amount you will get per month or per year. The minimum amount of retirement living in Canada, for single, it is about $1,500 a month. For couple, it is about $2,000 a month. As minimum income residents, one will qualify for housing subsidies and other benefits. Additional information about old age security. Allowance benefit is for spouse or common law partner between age 60 and 64, whose spouse is receiving or is eligible to receive OAS and GIS. Allowance for the survival benefit is also from age 60 to 64. You must apply for the benefit. The benefit is inflation protected. This means they are adjusted every quarter. OAS is a taxable benefit. GIS allowance and allowance for the survival benefit are tax-free. For detailed information on OAS and GIS, please check the following government website. Part 2 of the Canadian Retirement System is Canada Pension Plan Program or CPP program. CPP program is a contributory pension plan program. You have to pay into the system to get benefit. Benefit is based on the dollar value of contributions and the number of years you contribute. You can apply to receive benefit as early as age 60 and as late as age 70, with normal retirement age 65. Pensioners may benefit from a pension assignment. When a married or common law couple shares their CPP retirement pensions, they can reduce their income taxes. A brief history of CPP. Canada Pension Plan Program started in 1966. The benefit rate is 25% of pensionable income, defined later, until 2018. The contribution rate increased from 3.6% in 1966 to 9.9% in 2018. Early CPP pensioners have high rate of return due to low contribution rate. The later CPP pensioners have lower rate of return due to high contribution rate. Here is the table about the basic statistics of CPP contribution over the years. It started at 1966. Initially, the maximum annual pensionable earning is $5,000. This means the deduction only occurs for the first $5,000 earning. The basic exemption upon this means the first $600 earning is exempted from deduction, and the total contribution rate is 3.6%. By the year 2010, the maximum annual pensionable earning rise to 47,000, about 10 times higher, and the total contribution rate is 9.9%. And if we look at the basic exemption amount from 2020 or from 2000 to 2020, the basic exemption amount does not change over time. CPP program. First $3,500 of annual income is exempt from the CPP contribution calculation. At 2017, contribution rate is 9.9% of your pensionable earnings. It is the amount of income you earn between the year's basic exemption to the year's maximum pensionable earnings. In 2017, the year's maximum pensionable earnings is $55,000. CPP contribution rate is split between employees and their employers. It is 4.95% each. Self-employed must contribute 9.9%. CPP example: Colleen works as an employee in a company. In 2017, she earned income of $60,000. Her spouse, Chris, is a self-employed carpenter. His earned income in 2017 was $38,000. Colleen's CPP contribution amount would be calculated as follows. It is the lesser of annual income or the year's maximum pensionable income minus the yearly basic exemptions times 4.95%. It is $55,300 minus $3,500 times 4.95%. It is equal to $2,564. Chris' CPP contribution amount would be calculated as follows. The lesser of annual income or yearly maximum pensionable earnings minus yearly basic exemption times 9.9%. It is equal to 38,000 minus 3,500 times 9.9%. It is equal to $3,400. You must apply to receive CPP benefits. 2017 maximum benefit was $1,114 per month. You may apply early or delay benefits. In 2017, between age 60 and 65, benefits are reduced by 0.6%. for every month early. Between age 65 and 70, benefits are increased by 0.7% for every month late. CPP program is inflation protected. It is adjusted every January. CPP retirement pension is a taxable benefit. Employee contributions can be claimed as a non-refundable tax credit. Employer contributions are a deductible business expense. Self-employed individuals can claim both the tax credit and the expense deduction. The calculation of CPP benefit. The calculation is quite involved. For details, please check the following website. Essentially, the amount of CPP payment is 25% of average monthly pensioner earning, or AMP. CPP contribution starts at age 18, ends at age 65. We can remove 8 years with least income from calculation of average monthly pensionable earning. Some observation. Person with high income but short employment history pays very little CPP contribution. His CPP benefits will be high. A person with low income but a long employment history pays a lot CPP contribution. His CPP benefits will be low. Here's an example. Chris started working since he's 40. He earns $45,000 every year. He will retire at 65 after working for 25 years. Suppose contribution rate is 10%. His annual CPP contribution is 45,000 minus 3,500. This is the basic exemption amount. Times 10% equal to $4,150. After Chris retires, his expected annual benefit is 45,000 times 25%, which is equal to $11,250. Another example. Jason started working since he's 18. He earns 30,000 every year. He will retire at 65 after working for 47 years. His annual CPP contribution is 30,000 minus 3,500 times 10% is equal to $2,650. Jason's annual CPP benefit will be 30,000 times 25% is equal to $7,500. CPP example 4, continued from example 2 and 3. Suppose both Jason and Chris live to 80 years old. They will receive CPP benefit for 15 years. Calculate how much each contribute to and receive from CPP without considering time value. Solution. Jason's contribution is 47 years of working times 2650. This annual contribution is equal to $124,550. Chris' contribution, 25 years of working times annual contribution, which is 4,150, is equal to $103,750. Jason's benefit is annual benefit times 15 years. The answer is $112,500. Chris' benefit, annual benefit times 15 years, is 11,250 times 15. The answer is $168,750. So you can see that here, for Jason, his contribution is higher than benefit. For Chris, his benefit is higher than the contribution. Observation: Jason worked for long years. He contributed much, received little. For him, even without considering for time value, his contribution is higher than his benefit. Chris worked for a shorter period. His amount of benefit is higher than his amount of contribution. Start with drawing CPP benefit at different ages. The following table compares retirement at 60, 65, and 70. The benchmark payment for retiring at 65 is $13,000 annually. The maximum annual CPP benefit at 2017. When retiring at 60, CPP benefit is reduced by 36%. Annual CPP payment is the benchmark amount times 1 minus 36%. When retiring at 70, CPP benefit is increased by 42%. The annual CPP payment is about $19,000. This is a table about accumulative CPP retirement pension. For early retirement at 60, you start to withdraw money at 60. And so initially your amount of total benefit is high. Later, at age of 75, the normal retirement, this total amount will exceed the early retirement. At 80, the late retirement amount will exceed the early retirement. At 84, the later retirement will exceed normal retirement. Here is some discussion. Mark has decided to apply for earlier CPP benefit. Janet will apply for CPP at normal retirement age, and Bob will apply for CPP at age 70. Annual CPP benefit amount is calculated using the 2017 maximum monthly CPP retirement pension of over $1,100. Inflation is assumed to be 2% per year. Exhibit illustrate that Janet will receive an annual CPP benefit of $13,000 when she turns age 65. This represents 100% of the amount she is eligible for, calculated as 1100 times 12 months, which is $13,000 a year. Note that Mark received less than this amount, and Bob received more than this amount. As mentioned earlier, in 2017, benefits are reduced by 0.6% for every month that you take benefits early, and are increased by 0.7% for every month that you take benefits late, up to age 70. Mark is taking his CPP at age 60, which is 60 months earlier than the normal retirement age of 65. As a result, his CPP benefit is reduced by 36%, calculated as 0.6 times 60 months. Bob is taking his CPP at age 70, which is 60 months later than the normal retirement age of 65. As a result, his CPP benefit is increased by 42%, calculated as 0.7 times 60 months. The exhibit shows that even though Janet and Bob start receiving CPP benefit later than Mark, the total CPP retirement pension received by Janet and Bob will eventually be greater than the amount received by Mark. In Janet's case, her total CPP benefit will exceed that of Mark by age 75. Bob will exceed Mark's total CPP benefit by age 80, and he will pass Janet by age 84. The amount of CPP you will collect over a period of time should not be the only consideration as to when you apply for CPP benefits. The exhibit implies that Mark, Janet, and Bob will each live until at least age 86. Although this may not be the case, the exhibit does illustrate that if you have other retirement income options, you should carefully consider the timing of your CPP retirement pension application. Time value in consideration. The above discussion does not consider time value. If time value is considered, one should take CPP as soon as one is retired. The efficiency of government pension system. Many articles talked about the benefit we will receive upon retirement. Few articles talk about how much we have to pay for the potential benefit. We will briefly discuss the cost we pay for retirement. The easiest part to calculate is CPP contribution. For people earning $55,000 or higher a year, CPP contribution is over $5,000, including the employer's contribution. Old age security benefits come from general tax revenue. It is not directly connected to your individual tax contribution. As OAS benefits cover everyone, and benefit amount is often more than CPP, we can estimate our average tax contribution to OAS is at least $5,000 a year. With CPP and OAS, an average person pays about $10,000 per year for retirement. Our average CPP and OAS contribution is about $10,000 a year. Over 40 years of working age, our total contribution is about $400,000. Average Canadian lifespan is 81 years old. On average, we will receive 81 minus 65, which is equal to 16 years of benefit. The maximum retirement benefit for a single pensioner from the government is $24,000 in the year 2017. But not everyone is single, and majority have other incomes, such as company pensions. The average payment may be much lower than $20,000. Suppose the average payment is $20,000 over 16 years. The total payout is $320,000, which is lower than the total contribution of $400,000. This has not considered time value. Calculation of total retirement benefits from the government. Maximum benefit for single pensioner from the government is OAS plus CPP. The maximum OAS is $578, which is basic OAS plus $864. This is the maximum amount of GIS, Guaranteed Income Supplement, time 12 months, and plus the maximum CPP times 0.5. This is because for every dollar CPP you receive, the amount of GIS is reduced by $0.50. So we time the net income is half the amount. So we get is $24,000 or monthly payment of $2,000. So the first part is for OAS plus GIS. The second part is half of full CPP payment. The average CPP payment in 2018 is $664 per month. So this is much lower than the maximum amount. Total monthly payment would be $1,700. For the history of CPP contribution rate, please check the website and you can see that the contribution rate has been increasing over time. While CPP contribution has been increasing over time, CPP benefit rate has remained at 25% of pensionable earning after one is 65 years old. In the future, CPP pension benefit will increase to 33% over time, maybe at 2065. Concerns about retirement benefit in the future. In 2010, OAS and CPP represent more than 40% of seniors' total income. A single pensioner receiving 100% OAS and CPP will receive $23,997 a year in 2017. With high pension deduction in the youth, young people have less resources to support large families. Fertility has dropped below replacement rate for several decades. Population ages with low fertility rate. Will government-sponsored benefits be available to future generations? In an environment of population aging, what other retirement income options are available to Canadian employees? Retirement income, a comparison with prime time income. The median income of a Canadian household is less than $60,000 a year. If a family has 2 children, each person would have less than $15,000 a year. If you are from such a family, the retirement income from government alone is higher than your income in your prime time. There are other sources of retirement income, such as company pensions. The following is a good talk about wealth distribution among generations and its social impacts. The title of the talk is Have the Boomers Pinched Their Children's Future? The following article from Globe and Mail discusses some new developments on CPP. Observations from the Globe and Mail article. How the increase of pension deduction was introduced. The Federal Finance Department said the portion of earning between $54,900 to $82,700 will have a different contribution rate for workers and employers, expected to be set at 4%. That is not the case. The contribution rate for that portion turns out to be the same in later years. The statement was made in 2016. In 2017, the contribution rate for higher portion was the same. If the government could not keep promise made less than 1 year ago, how likely it will keep the promise made decades ago? Another observation is about the language of benefit and cost. Benefit is called benefit. Cost is not called cost. In the article, it is called funding. The title of the section is How Will Higher Benefits Be Funded?